So today, I feel like it's a little bit of a bonus because not only do we have one of the national experts on student loan debts that can help our clients who walk in the door with lots of different types of debts. One of them, of course, can include student loans. But I would assume that some of us on the call still have student loans hanging over our heads, so it might be a little bonus for those of us who still struggle with them. So with that, we have Persis Yu from the National Consumer Law Center who is presenting on student loan debt, and hopefully it'll be helpful for our clients in managing their overall financial situation. So thank you, Persis.
Thanks, Becky. Yes, as Becky mentioned, I too have student loan debt as well, and so one key thing in being able to help others is making sure that we take care of ourselves in the meantime as well. But thank you for that introduction. Like Becky said, my name is Persis Yu. I'm an attorney at the National Consumer Law Center. I work in our Student Loan Borrower Assistance Project. And so some of what we do at the Student Loan Borrower Assistance Project is we work on policy work. We advocate with regulatory agencies, the Department of Education, the Consumer Financial Protection Bureau, members of Congress, and different state legislators to craft laws and ensure enforcement of those laws to protect low-income student loan borrowers. But we also are a little unique in our project because we do some direct representation as well, and that's been very helpful and instrumental in doing our policy work and really keeping our feet on the ground with what's going on out there. So for this webinar, as I understand that most of the folks here today are working with homeowners, and so we're kind of looking at where the student loan may be impeding their ability to keep their home. This is a very, very broad overview. Student loans are incredibly complicated and multifaceted, so this is going to be very high level, but at the end I'll give you some additional resources for when the questions get a little bit more in depth than just your basic general knowledge about student loans. So the first thing that we're going to cover today is just figuring out what type of loan a client has. And that does seem kind of intuitive, but really that's probably the #1 place where most people get tripped up when dealing with student loans. There's a lot of information out there in the media on different, financial websites about how student loans work, but a lot of it actually depends on what kind of loan we're talking about even to begin with. And so I think that's where a lot of just the general confusion and apprehension about student loans just gets started, because a lot of people don't even realize what they're dealing with. So the next thing that I'm going to try to delve deeper into is really the federal loans. And the reason why I talk mostly about federal loans is because it is the vast majority of loans out there. I'm sure many of you have heard the $1 trillion mark has been, about outstanding student loans, and it's about 1.1 trillion of all student loans, and I'd say about 900 billion of that is federal loans. So we're really looking at about 90% of the loans out there are federal. We're going to talk about default versus delinquency. This is something that's very unique in the student loan realm, that those two things are not the same. Many other forms of credit, default and delinquency can be thrown around somewhat synonymously, but there's a very, very meaningful difference in the student loan context. If you have someone who is pre-default, what are their options? And then if you have someone who is in default, what are their options? Now, I am really focusing on distressed borrowers because I am making a general assumption here, which I know will not always be the case, but the general assumption is that if you're dealing with it, it's because there's a problem. And we're not necessarily talking about a borrower who is in good standing and is doing okay on their loans. So a lot of the information will also apply to them, for example, with the types of repayment plans. Lastly, I will go into a little bit of detail about the private loans because it is important to know that there are some options, but then also, but like I said, the majority of the loans that you're going to see are going to be federal loans. So, start with a pop quiz. I'm not actually going to quiz you. You don't need to respond, but just kind of as a mental exercise here. A lot of counselors, the first time that they see that a borrower has a student loan is when it appears on their credit report. So what I've done here is I've taken a snapshot of a borrower's Sallie Mae trade line from a TransUnion credit report. And from this, kind of had this mental exercise. Well, what kind of loan does this borrower have? Now, I talk with hundreds of borrowers every year, and invariably I ask them, what kind of loan do you have? And the answer is almost always, I have a Sallie Mae loan. And the answer is that tells me absolutely nothing about it. And unfortunately, the credit reports don't have any way of distinguishing what kind of loan it is, whether it's a federal loan or a private loan. And those are the two main distinctions that we're going to stick with today. So you'll see that, under the loan type, it says it's a student loan. You have the lender. You say that it's Sallie Mae, and we'll go into a little bit more detail later on why Sallie Mae is not actually an instructive answer. But really, all that the credit report is going to show you is it a student loan, and is it in good standing, and is the borrower in repayment? And it might tell you the total balance as well. So we don't actually get a lot of information about the type of loan from the credit report. So what are the different types of loans? There's the government loans versus the private loans. The government loans, and this is why it gets confusing, is because by government we mean government guaranteed loans, not necessarily made by the government, although there are those as well. And then there's the private loans that are made just by your traditional banks, your Chases and Bank of Americas, and your Sallie Mae's. So what are the different types of government loans? The federal loan program started in the 70s, and up until 2010, the vast majority of the loans came from private lending sources known as Federal Family Education Loans. FFEL is what we call them, and is what I'll refer to them throughout this webinar, is the FFEL loans. They come from private lending sources, but they're guaranteed by the federal government. So what would happen is Bank of America, for example, would make a loan to a borrower, and then if that borrower were to default on the loan, the government would repay Bank of America. So that's how it was guaranteed. After 2010, they stopped making those loans. Now all loans come from the U.S. Department of Education. They're direct loans. Within that umbrella, we see Stafford loans, which are kind of your garden variety student loan. It's going to be the one that almost everyone has. It makes up the vast majority of the federal loans, and it has the most generous repayment terms. It comes in both subsidized and unsubsidized, which is generally referring to the treatment of interest. So the subsidized are the ones where the government pays the interest while the borrower is in school. There are also PLUS loans, which are available to parents of undergraduates or grad students. And this is allowed, Staffords have a loan limit to them, and so if the borrower has need beyond what the Staffords can provide or other aid can provide, then if it's an undergrad, the parent can supplement up to the cost of attendance with a PLUS loan, or the grad can do that in their own education. And then there's consolidation loans, which are kind of what they sound like. The federal government allows borrowers to consolidate all their loans into one place, which may help if a borrower with the older loans had borrowers with multiple different lenders. And then lastly, there's the Perkins loan. The Perkins loan is a very unique animal in all of this because it's actually lent by the institution itself. But it works similarly to the FFEL loans, where the institution makes a loan, but it's guaranteed. And then but these follow the federal rules. So how do you find out about whether or not a borrower has a federal loan? And the best source of this information is the National Student Loan Data Service, which is NSLDS. And this is probably about, I would say roughly 95% of federal loans are in this database. It's helpful if you're meeting with a borrower and you know that they have some kind of student loan issue to have them check before, and to bring actually a printout of their NSLDS report is what we call it. The reason is because you need a PIN to get your information. It's the same PIN that borrowers use to fill out a FAFSA to apply for financial aid, so they may have it on some piece of paper somewhere, but many borrowers don't have that information and they can apply for it at pin.ed.gov, but it will take them a couple days to do it, so it would be best if the borrower can get that in advance. The other reason to get it in advance is because legally, no matter what kind of authorization you have, you as the advocate are not allowed to have that PIN or to access the borrower's NSLDS report for them. The rules are incredibly strict on that. It's kind of complicated and gets a little ridiculous sometimes. There's a number that you can call as well. If you go to the website, you can find the phone number. But we've had situations where, you know, you have a client who you know just does not have the capacity to get this information on their own, and we've made phone calls and been told that we can't be on speakerphone, that the client has to relay all the information. So they are very, very strict about who can access the report. In terms of practicality for those clients, you know, sometimes what we will do is we will walk them through it. So, you know, I'll make sure that they have their PIN in advance, but then say, okay, bring the PIN and I will let you access it on my computer in my office. And that's one of the ways that we're able to get the information. But it is really the key place. The reason why there's about 95% is because the database was started in the early 90s. So every loan that was made after that point is definitely in the database. It's a little spotty beforehand, where you'll see basically all of the 90s are in there. A good portion of the 80s, of loans from the 80s are going to be in there, and very few loans from the 70s are in the database. So if you're talking about a very, very, very old loan, it may not be in the database. But otherwise, if we're talking about a loan that was in when I say recent, I mean in the last, you know, 10, 15 years, it's going to be in NSLDS if it's a federal loan. So accessing NSLDS, this is what the website looks like. You're going to go into financial aid review. The borrower is going to input their social security number, name, date of birth, their PIN number, and then what you're going to get pulled up is going to look something like this. It's going to look flashier because it's not going to be printed and then scanned, but it's going to look generally like this. It's going to give you a list of all the federal aid, with the, you know, exception that I just gave you a moment ago, that the borrower has. And so you can see with this borrower, they have taken out a total of 8 loans. 4 of those were paid off. We see that 2 of these are consolidated, which my basic assumption about that is that that consolidated loan probably paid off the other 4. The other very, very important piece of information is that the 4 loans that still have a loan balance are currently in default. And that's what this little triangle with an exclamation point means, and it's yellow on the actual website, is that this loan is in default. The other information you're going to see is you're going to see the outstanding principal balance, the outstanding interest. Now, one thing that's important to know that does not appear is collection fees and costs. And so if your borrower is in default, the loan balance is likely going to be greater than how it appears on the NSLDS report. So that's important to keep in mind if, you know, the borrower is looking at this number and says, oh, I owe, you know, approximately $20,000. It can actually be much higher than that. And the limit for collection fees is fairly high. Right now it's 25% of the principal and interest for the Stafford loans, for the Stafford, the Consolidated, and the Plus loans. So if this borrower owes about $20,000 in principal and interest, those collection fees could be as high as $5,000.
Excuse me. Is there a charge to get this report?
I'm sorry?
Is there a charge to get this report?
No, it is available for every borrower. If you are, I mean, for those of you that have student loans now, you can go to NSLDS report, NSLDS.ed.gov right now, enter in your information, and pull up your own report. It is available to all borrowers at all times. The other piece of information that's on this report is the Pell Grants, and that's generally more interesting than anything else. The one thing that is a little bit interesting for some borrowers is that you'll see this lifetime eligibility used, and that's because there is a limit on how much a borrower can use. It's currently, I think it's 6 years, and so it can get up to 600%. It used to be higher, and it's been recently reduced, unfortunately. So that's how, so then when you go in, if you want to get more information about that specific loan, you would click on the number or click on the loan, and then you'll get a more detailed sheet. This page is also very useful. It will give you kind of a very rough history. It's not going to give you kind of like payment history that you're used to in the mortgage context. You're going to get very broad information in terms of you were in default as of this date, you were in a forbearance as of this date, or you were just generally in repayment. But it's not going to say, you know, you were in an income-based repayment plan, how much you actually paid, or anything like that. It's going to have very broad information. But what's going to be very useful, especially if the borrower has no idea what's going on with their loan, which many of the people I work with have no idea what's going on. They're kind of vaguely aware that they took one out when they went to school. But it's going to say, you know, what school they attended, when they took it out, and probably the most key piece of information is who they should contact about that loan. And so this is a loan that's in default, and it's held by the U.S. Department of Education, so it's with the Debt Management and Collection System. So if you want to find out, it's going to be sent to a debt collector, but if you want to find out who that debt collector is, you would contact this department here. If it's in good standing, it'll have a servicer. If it's a FFEL loan, it will say who the FFEL lender and guarantee agency is. So those are the federal loans, but how do you find out about the private loans? And how do you know if it's a private loan? They don't usually use the word private loan, but they will have other types of names to them. You know, for example, for the lawyers, and many of you may have law achiever loans or other types of loans that are similarly titled to that. The other key thing is that private loans are required to have TILA disclosures. So they have those little boxes that say, you know, the amount of interest and the total cost of the credit. That will be, if you see one of those, that's a key indicator that that's a private loan. Private loans have no loan limits. So you will see, so higher interest rate loans will be private loans. The highest federal loan that I've seen, I think the limit on the federal loans is around 8%, 8 to 9%. So if you see something in the double digits, then it's definitely a private loan. And unfortunately, many private loans do have double digits APRs. No cosigners for federal loans. And this is a question I get all the time. Somebody says they're a cosigner. What are their rights? If I hear the word cosigner, an immediate flag goes off in my head, and that makes me think this is a private loan. Now, the federal loans, the Federal Plus loans do have a somewhat analogous system like a cosigner. They call it an endorser, and it basically serves the same function as a cosigner. But again, that's only for the Plus loans. That's a very small portfolio of the entire federal loan portfolio. And if you see the word cosigner, like if you're looking at the promissory note itself and you see the word cosigner, then that's definitely a federal loan. It's not on NSLDS. None of the private loans, sorry, will be on NSLDS. So that's a key way to know that it's not a federal loan. With, again, the exception that I told you. If it's a loan from the 70s, we may have more questions about it. But generally, for the, most of the private loans that you're going to be seeing coming across are going to be from the last, at least the last 20 years. So they should, if it were a federal loan, they would be on NSLDS. They will, however, appear on bills. They will appear on the credit reports. And if you're really digging, it can be a pain to get, but sometimes worthwhile to try to actually contact the school to get the borrower's financial aid documents from the school. And under FERPA, students do have access to their records, but schools don't necessarily need to give it to them in a very convenient form, and there's no enforcement mechanism for that, so some schools have been known to ignore that requirement. So I'm going to take a quick break here for maybe 4 or 5 questions if we have them.
Yeah, right now there seems just to be some questions about the audio. There's some warbling going on, but there's no questions at the moment, and we're trying to figure out if there's something wrong.
Okay, and I will try to speak a little bit slower, so if there is warbling, hopefully you'll still catch most of the words.
Thank you.
All right. So probably the meatier part of the question is, so you have the student loan, you figured out that it's a federal student loan. What do you do with that piece of information? How do you help that borrower? Now this is the general approach that we at NCLC use to dealing with student loans, to somewhat make sure that we're not missing something. So what we want to do is we want to go through kind of as a checklist, if you will, at least in our head, as to what can I do to help this borrower. Obviously, the most complete remedy and the best thing for the borrower would be if I could get rid of the loan altogether. Now that sounds really fantastic, and so obviously it doesn't apply to a ton of borrowers, but there are people that will qualify for cancellation of their loans. I'm not going to go into a lot of detail about it because it is really technical and specific. Our website is on one of the later slides, and we have information about all of the administrative cancellation programs, which may include if the borrower is disabled, if the borrower dies, and if there are certain malfeasances on the part of the school that could qualify a borrower for a discharge. There are also going to be some borrowers who qualify for bankruptcy, and I'm not even going to say more about that because it's a whole can of worms and probably a 2-hour webinar in and of itself at least. But some borrowers will qualify for bankruptcy, although as many of you know, if you ever listen to the news, it's very hard. So now for most borrowers, cancellation is not going to be an option. What we're going to want to do is we're going to want to get the loan into good standing. If they're not in default, is there a way that we can either postpone it, if they're experiencing a very temporary hardship, or is there a way we can modify the repayment so that it can be affordable for them? And if they are in default, is there a way that we can get them out of default so that we can then pursue those options? If there's not a way we can get the loan in good standing, we then look for kind of ways that we can just mitigate the harm that's happening. Can we compromise with the lender, settle the loan, or at the very least, is there a way that we can just argue against the collection? And there are our hardship provisions, or, and we're dealing a lot of the time with third-party debt collectors, which you all know violate the law a lot. So there may be ways to challenge collections on those grounds too. So that's the general approach that we have to dealing with federal loans. Delinquency. So like I told you at the very beginning, there is a definitional difference between delinquency and default in federal loans. Delinquency is anyone who has missed a payment but has not yet missed 270 days. They're not yet 270 days behind on their payment. So this is a very bright line. The 270-day mark or 9-month mark on federal loans is a bright line. You're in default after you were not in default before. You're just delinquent. And while you're delinquent, you maintain your eligibility for deferments, forbearances, and all of the repayment plans. So delinquency, unfortunately, in my practice, I do not catch a lot of people in this delinquency period. But if you do, and you may, people that you're working with, you may actually see this period more often because you're going to see more immediate effects. And it's actually, obviously it's not good to be delinquent, but if you are going to see, it's great to catch people in this period because there's so many options available. So one of the options are to postpone repayment. There are deferments. And there are deferments for unemployment, for economic hardship. There are some random other deferments, but those are probably the main two that borrowers are using these days. The benefit of a deferment is that there's no interest on subsidized loans. The other way to postpone repayment is through a forbearance. And really the only meaningful difference between a deferment and a forbearance is really this interest piece. So interest will accrue during the forbearance period regardless of whether or not it's a subsidized or unsubsidized loan. They have forbearances for economic hardship. There are also mandatory and discretionary forbearances, which is kind of a confusing category, but there are lots of different triggers. For things about forbearances is that they are much easier to get. Deferments have forms. You generally need to send in economic documentation of income, or if you're unemployed, a letter from your state unemployment agency. Forbearances can often be done over the phone, so if we're talking about you really need a quick forbearance just to really even sort through the options, then you can just pick up the phone, call the servicer, and the servicer can put a forbearance in place. That's a really quick and easy option, but it doesn't have some of the benefits that the deferments have. So it's important to know and kind of weigh the options for those two. The other benefit for the economic hardship deferment is that if you do have a borrower who is in income-based repayment, which I will talk about in more detail a little bit later, the time that you're in an economic hardship deferment actually counts towards the forgiveness at the end of the income-based repayment period. So that is a huge boost for someone if there's a reason why a deferment would work better than a repayment plan. So these are the repayment plans that borrowers typically have. The standard plan, if you never do anything to touch your repayment plan, is going to be a 10-year amortization schedule. This is usually the highest monthly payment option of all the other plans. The other options are an extended repayment plan. Not all borrowers qualify for it. You have to have a loan balance of over $30,000 before you can qualify for an extended repayment plan, and then it's extended based upon how big your balance is, and the maximum is a 30-year extended repayment plan. There's graduated repayment, and that's in both the standard and in the extended. And it basically makes it so that the time period is the same for repayment, but the amount of the repayment kind of steps up over time. And then what we have found for the borrowers that we work with is that most borrowers are looking for some kind of income-driven plan. And there are just so many options. There's so many acronyms because they seem to be tweaking. We're running out of ways to overarching categorize what so now the term is income-driven as an umbrella term for these payment plans that are somehow calculated using the borrower's income. There's income-sensitive repayment, which is nearly obsolete in the FEL program. There's the income-contingent repayment plan with the direct loan program, which is also not quite, but similarly headed towards obsolescence. The only difference is if you are talking with a Parent Plus borrower, income contingent is actually the only repayment plan that's available to them. And there's some complicated steps to even do that. And then what's probably better known now is the income-based repayment. That's the repayment plan that there's a lot of push from the Department of Education, from the White House to get more borrowers enrolled in income-based repayment. It works functionally very similarly to income contingent, but it has a more generous repayment formula. And the last one is pay-as-you-earn, and that's the new program that Obama instituted a couple years ago, and it uses an even more generous repayment term. So how do you find out how much the borrower would pay under each of these repayment plans? And there's a bunch of calculators out there. We have links to some of them on our website, and probably actually the best one now, the Department of Education has recently revamped their website, and it is actually fairly useful. So I would encourage people to go visit the Department of Education's website. It's studentloans.gov. The link is right here. And what you're going to do is you're going to put in the amount of your loan balance, the interest rates, and the amount of your income, and it'll generate this table for you. So this particular borrower that I generated this table for had $45,000 in student loans and an income of roughly $30,000 a year, and for a family of 3. And so you can see that this borrower would be paying a little under $500 a month under the standard plan. Under the you have the graduated, and then you get to the extended, where it could be as low as $224, and then you get it down to the income-driven plans, the pay-as-you-earn, $12 a month. Income-based would be $18 a month, and income contingent would be $155. So you can see that there is a wide range of payment options for this particular borrower. So it's a really helpful website to see. What they've also done is they've projected for the borrower's information the anticipated total interest paid. That's fairly straightforward for standard plan. You know, for the plans that are based upon amortized schedule over a certain number of years, you can predict what the interest will be in advance. That's harder for the income-driven plans because you don't know what your income will be. You have to recertify your income every year. So there's a little bit of guesswork in here, but what they've done is if you look at the initial to final payment, they're assuming that people's income will increase by, I think the formula is roughly 3% a year. So they're working off of that assumption, and based upon that assumption, if your family size stayed the same, what would your final payment amount be, and how much interest would you pay over the life of your loan? But obviously that's not a precise figure, so borrowers should take that with a grain of salt. The more immediately important information is in this first column. So income-based repayment, how does it work?
Persis.
Yes.
I apologize to interrupt you, but can you just, because of this warbling, one person wasn't quite able to hear, could you slowly repeat what you had said, if you can recall, about deferments counting toward principal at the end?
Okay, yeah. So in income-based repayment, that actually it works well with this slide as well. In income-based repayment, after you have been in repayment for a certain number of years, for most people it's 25 years, it's going to be 20 years for loans made either in 2014 or after, or for borrowers who are in pay-as-you-earn. It's 25 years of payment in income-based repayment. However, there's a lot of exceptions in there. And so if you're in an economic hardship deferment, that time in that particular deferment actually qualifies towards those 25 or 20 years. So that's a little bit of a jump on how income-based repayment works. But the how the payment amount is calculated is based upon a percentage of the borrower's discretionary income. The discretionary income is the borrower's adjusted gross income. The difference between the borrower's adjusted gross income and 150% of the federal poverty. So most borrowers will pay 15% of this discretionary income. So let's say that borrower makes $45,000 a year. 150% of poverty for that family is $15,000, just to make up a number. That's not based upon any actual, Health and Human Services chart. But so then the discretionary income is going to be $30,000, and then the annual payment amount will be 15% of that divided by 12, or if they're on pay-as-you-earn or a new borrower, it'll be $3,000 for the year divided by 12. So that's the basic formula that they use. It's not terribly complicated math. I can do it. So, but luckily there are calculators, so that's helpful. And it is important to know that this 150% of poverty is for that specific borrower's family size. So it's hard to make a blanket statement about how much that's going to be without knowing, how many people are in their household. And, if for some reason you're dealing with borrowers who are in Hawaii or Alaska, they also have a different number. The other thing to know is that this may be different after 2015, just to be a little bit more complicated, because currently there's, for borrowers after 2014 or some borrowers earlier, they are eligible for the formula to be 10%. The Obama administration has announced that they want to extend that to more borrowers. However, we're not expecting those rules to be very straightforward. We're expecting there to be some kind of either tiering system based upon the borrower's income. So maybe it's 10% for borrowers who make less than $50,000 a year, but it's 15% for borrowers over that. We're not quite sure, but we expect it to be different, and we expect it to be complicated. So that's the takeaway from the new repayment plan that we see coming down the pike. The one really good thing that has happened is that there's a new website, studentloans.gov, and borrowers can actually apply, most borrowers can apply online on this website, and what it'll do is it'll automatically import the borrower's tax return from the IRS. And so it's very simple for most borrowers. And I say most borrowers because not all servicers are connected to this online portal. All of the direct loan borrowers will have access to it, and a large percentage of fellow borrowers have access to it. But there are still a couple holdouts. But if a borrower doesn't, if their servicer isn't linked to the portal, you can still go to the website. It'll pre-populate the forms. It'll still access the IRS tax return, and then what will happen is that you can just print it out and then mail it to your servicer, to the borrower servicer. So it's a really helpful website. There are, a few bugs because it's new, but it is a much simpler process than there used to be. So for the borrowers who have crossed over the line, they are more than 270 days in default, days late on their loan, and their loan goes into default. So at that point, the entire loan balance does accelerate, and 100% of the loan is due. It is the policy of the Department of Education and most of the FEL lenders to send the collection of that loan to a private debt collector immediately. And the tactics that these debt collectors use are exactly the same as they do for any other type of credit. Borrowers are often subject to aggressive and illegal collection tactics. The collection agencies are, for the most part, the exact same collection agencies that, Chase, Bank of America, and any other mainstream lender uses. We don't necessarily, I have not seen, the super egregious behavior, the pretending to be a sheriff or a police officer and threatening arrest. Not quite that bad. At least I haven't seen it. I have heard stories of it being that bad in the past, but there is still a lot of deceptive conduct that happens with these debt collectors. A lot of misrepresenting of what borrowers' rights and obligations and what the consequences are. The default will also be reported to credit reporting agencies. If the borrower is in default, they will be prohibited from taking out any new federal loans or grants. This kind of puts a lot of borrowers in a catch-22 because one of the #1 reasons that borrowers default, or not reasons, but risk factors for default, is not completing an education. So borrowers don't complete their education, they don't have a job that benefits from the degree, so they can't repay their loans, and then they can't go back to school to finish their education because they're in default on their loans. And it applies to Pell Grants too. So even if one could make the argument that, well, it makes sense, you don't want to lend more money to somebody who has a history of not paying it back, the Pell Grants don't need to be paid back. So that kind of policy reason isn't really in effect. It's kind of more as a deterrent or a punishment, really. So the borrower will also be subject to the government's collection powers. It's important to know that unlike other types of debt, the government can pursue borrowers forever. And that is why we actually do see borrowers from the 70s, from the 80s with student loans creeping up to haunt people. Now, one thing that may happen is that if people are trying to refinance and into a Fannie or Freddie or a HUD loan or some kind of government program, and a student loan may may stop that, but actually it may not appear on the credit report because the 7 years obsolescence requirements under the Fair Credit Reporting Act apply to federal loans, even though the statute of limitations does not exist. So there are going to be loans that are too old to appear on somebody's credit report, but are still in default and are still enforceable against the borrower. So that's probably very important to know. The other thing is that the government has extraordinary collection powers without a court order. The government can and very frequently does borrower's tax refund. So if your borrower is qualifying for the Earned Income Tax Credit, the government will take 100% of that if necessary to repay the loan. Any kind of child care tax credits, just your regular refund, it will be intercepted, and that's both on the federal and the state level. Although it's easier for them to do it on the federal level, so it almost always happens with federal tax returns. The government can garnish a borrower's wages without a court order. And if the borrower is receiving Social Security pension or SSDI, the government will also take a portion of those benefits. The borrower does have some due process rights, but really what that amounts to is they get a 30-day notice and they have the opportunity for a quote-unquote hearing, which is really just they fill out a form and send it back, saying either, at that point, no, I don't owe it, or, this is going to cause me an extreme hardship, so can you please not do it? But that is sometimes effective and sometimes not. The government also does sue borrowers from time to time. It is fairly rare. Less than 2% of their collection activity is done through litigation. But the Department of Education currently holds about $50 billion in defaulted student loans. So even 2% of that is still a large number of people, and not a insignificant number. So we do see them. And actually, New York is one of the districts in which they have contracts with private attorneys to do those lawsuits. So New York is one of the places where we see more litigation than any other place. But it is still, in terms of the overall volume of student loans, it is a very, very small number of people who are taken to court. And usually those are people who have high loan balances and have assets, because if we're just talking about somebody has significant assets, because if we're just talking about somebody who's working and doesn't have a ton of assets, it's not really beneficial for them to sue, because they can just take someone's wages without suing, where they can take the tax refund. So that's why it's pretty rare, but it does happen, and so borrowers should be aware that that's a possibility. So how do you help how do you help this borrower who has crossed that line into default? One of the options is to consolidate the loan. Consolidation is very similar to refinancing. What the borrower essentially does is they take out a new loan which repays the old loan. In order to qualify, if you are a borrower in default, you need to make 3 timely payments that are supposed to be reasonable and affordable, which means you're going to have to negotiate that amount with the debt collector, or you can agree to repay the loan in income-based repayment or income contingent. Theoretically, you can also do pay-as-you-earn if the borrower qualifies for that program, but that's not explicitly said. That's just something that we assume based upon how the regulations work that should happen, but I don't know if it actually has happened. Studentloans.gov, again, is the website that you can go to do that online. This is a very new process, like within the last 5 months. The department is now accepting consolidations through this program. Borrowers will select a servicer based upon what information we have not yet figured out. If they're currently with Sallie Mae and they like Sallie Mae, they may select to stay with Sallie Mae, or what more commonly happens with me is they're with Sallie Mae and they hate Sallie Mae, so they throw a dart at one of the other 3 servicers they can choose. So that's a website that one would go to in order to consolidate. There's also a paper application that people can send in for those folks who are phobic of doing all this private information online, which I think is fairly reasonable. The other option to get out of default is to rehabilitate the loan. And this is where one does not have a new loan. One keeps the loan that they have, but they just work out a payment plan that will then get it back into good standing. And how a borrower does that is they agree to make 9 timely payments during a 10-month period. So they can miss 1 payment during the rehabilitation period. The monthly payment should be reasonable and affordable. There's a brand new regulation out, took effect on July 1st, 2014, where the debt collectors and servicers and lenders working with a borrower to rehabilitate the loan should use the 15% IBR formula to calculate what reasonable and affordable. And the reason for that is because this used to be the biggest fight that we had with debt collectors, is that a borrower would want to rehabilitate their loan and we could never work out a reasonable and affordable repayment amount. I had one borrower who was homeless. His only source of income was a very limited veteran's disability of like $200, and the debt collector said his reasonable and affordable payment amount was $150, which is obviously not reasonable and affordable for that borrower. But long story short, it had to do with how they were getting paid. So we had a hard time negotiating that, and so there was some press and some embarrassment for the Department of Education on that front, which is why they now they now have a prescribed formula for how to determine what reasonable and affordable is. Now, there are going to be borrowers where that 15% of the income is not actually affordable. This is one of the downsides to income-based repayment just generally, is that there was a very smart economist who determined that 15% was the ideal amount to repay on your student loans for the average borrower, and so that's how they came up with that formula. However, there are going to be people who have, you know, a lot of other debts. For example, they may have medical debts, they may have medical expenses, they may have private loans, which, you know, eat up a greater percentage of their income, or they may live in a really expensive part of the country. So there are going to be borrowers for whom the 15% formula is still not affordable, and they are required to calculate monthly expenses to determine reasonable and affordable, and there's a prescribed form that they have to use. The fight that we're currently having is whether or not they can cap borrowers' expenses. You know, for example, say, well, I don't think you really need to spend $150 on your cell phone bill a month. We think that they shouldn't be capping that, and you know, there may be some argument about maybe some expenses aren't reasonable and that there are some that shouldn't be included, but there's some that are, and you know, there are reasons why some people have to pay more for some things than other people. So that's how a borrower would go about rehabilitating. Kind of the costs and the benefits to these two programs. The main benefit to rehabilitation is there is a slight benefit to the credit report. The debt collectors and the lenders will try to say that there is a huge benefit to the credit report. Now what's required is to remove the record of default. Now I have never seen the word default on any credit report. So what it'll do is it'll remove the indications of default, such as if there was a collection agency involved, or if it's a failed loan, whether or not the loan was repaid by, you know, the government, for example. But what doesn't get removed is the repayment history, which is, you know, the vast majority of information about the loan. So, you know, if the borrower's, you know, 3 years behind on payments, that's still going to appear on the credit report. But the record of default being removed is not nothing, and it does remove some things, and it does boost a borrower's credit score. The estimates are, on the lowest end, the estimate I've seen has been 5 points, but the highest estimate I've seen has been closer to 40 or 50 points. So, you know, for some borrowers, if your borrower has a 500 credit score, the rehabilitation is not going to be very beneficial. You know, it's going to take them from really, really bad to just really bad. And that's not going to be, that may not make it worth it. But if you have a borrower who has a, you know, 690, you know, 30-point boost to their credit score could be incredibly meaningful. So that's something to consider. And the other thing for, you know, for the lawyers and then for other people to know, just to kind of be aware of that there is a legal issue here. Because a rehabilitation does not create a new loan, any defenses the borrower had beforehand, it still exists. So, you know, if they could argue, you know, for many borrowers, they may say, I don't really think I owe this money because there was X, Y, and Z malfeasance when the loan was taken out, but I'm not in a position to argue that right now, or there's not a really convenient venue for me to argue that. So I'm going to come up with a repayment plan. What I didn't mention before, and it's very important, in income-based repayment, your payment amount can be as low as zero. So for people whose income is less than 150% of federal poverty, their payment amount is going to be zero. So there are going to be many borrowers. So borrowers in that circumstance might say, look, it's still better to be in good standing on this loan than to be in default, even if I think I don't owe the money. So if you rehabilitate, you'll preserve that defense for later down the road. Whereas with consolidation, some defenses are preserved, some aren't. And that's, if a borrower doesn't think that they owe the money, that's a reason that one might weigh rehabilitation over consolidation. However, the benefits to consolidation are that it's faster. If you need that loan to be out of default, you know, well, not right now because consolidation does take time too, but definitely not next year, then consolidation is a much faster option. You know, for rehabilitation, we're talking about 9 payments, so that's at least 9 months. It's going to take at least a month to, you know, get that plan set up. And then at the end of the month, it can take up to 60 days to get the loan, the fact that the borrower is out of default and processed into a new servicer, get the repayment plan set up, etc. So for rehabilitation, we're really looking at a year from the time the borrower walks in the door. Whereas consolidation, it's just a time for administration, which, you know, they're not, the government doesn't move at a lightning pace. But, you know, it's still, you're still talking about 2 to 3 months probably from start to finish.
Persis?
Yes.
I want to just temporarily interrupt you, and for those of you who have a hard stop at 1 o'clock, Persis has a few more slides, I believe, and there's also a number of questions afterwards. I just want to give folks an opportunity. The CLE code, it's in the chat box, but the number is 2113A, and you can send, Michelle will handle participation credits and CLE credits for you. And hopefully, if there are a number of questions, and hopefully if you're able to stay on the line, Persis, you are able to answer some of those beyond the 1 o'clock mark?
Yep.
Great. Okay, go ahead. Sorry. Oh,
okay.
Michelle, was there anything else that I needed to say? Michelle's probably on mute.
Sorry, no, that covers it. Thank you.
Okay. All right, go ahead. Thank you.
Okay. So I'll wrap this up really quickly, so because I do want to make sure that you can get to your questions and then just touch on real quickly private loans. So, you know, some things are the same. There is actually a smaller limit to collection fees if the person does rehabilitate or borrow. Legally, it's 18.5%, although if a borrower does rehabilitate and they have a department-held loan, which again you would find on their NSLDS report, at this moment, the Department of Education is actually waiving collection fees for people that rehabilitate. So again, that can actually be a large chunk of money depending on the loan balance. So, you know, these are the things to weigh. Either way, borrowers can select income-based repayment, income contingent, or pay-as-you-earn as they qualify. After they get out of default, then they'll also be eligible for their deferments and forbearances, etc. The other thing to know is that each of these is a one-time deal. You can only rehabilitate once, and you cannot consolidate a consolidated loan unless you're adding new loans. But generally, the idea is that you have one shot at either one of these. So that means there are going to be some people who cannot get out of default due to either judgments or because of but they've already rehabbed and consolidated. So what those borrowers, you know, are really left with is options to settle the debt, challenge collections. They may be able to work out a payment plan with the debt collector, which will at least keep them at bay. Will likely keep them from garnishing their wages, although they won't likely stop the tax refund offset. So I'm sorry to kind of gloss over this. But like I said, in your slides you have access to other resources where you can learn more about any of these options. And then what to do for private loans. The private loans are actually, this is actually a really nice product for people who are not student loans but otherwise work in financial products because they actually work like any other type of unsecured credit. You know, there are very loose laws and regulations surrounding them. Basically, they can't be deceptive, but there's no requirements about the interest rates. There's no requirement that they provide forbearances or deferments or any of these other kinds of options. There's no requirement for cancellations. So it really is just like any other unsecured credit, and what's gonna determine what the options are is that borrower's promissory note. some lenders do offer forbearances, although they tend to be very limited, and they sometimes have fees associated with them. If a borrower can't afford their payment, or if they are behind, it is it's a negotiation like any other kind in order to try to get back up to speed. There, again, is no requirement that lenders provide any kind of modified repayment plan, though some will. Some have been very flexible. Some are very inflexible. I will say, having worked with Sallie Mae for a number of years now, they are incredibly inflexible with borrowers. But a lot of the smaller lenders actually do want to help borrowers out. So, so they may come up with interest-only payment plans, although, the borrower does want to consider whether or not entering into a payment plan, which will never actually pay off the loan balance, is worth it, because private loans do have statute of limitations as well. They do not linger forever. The only thing is that the bankruptcy rights are limited. The bankruptcy rights for private loans are the same as they are for federal loans. So a borrower has to be able to jump through the hoops set up through that system in order to cancel it for bankruptcy. But otherwise, their rights are exactly the same. If they're going to garnish your wages, it means that they've taken you to court. If there's going to attach any portion of a bank account, they have to go to court to do that. So a borrower has the option to challenge that in court with all the joys that come along with that process. If a borrower, if you're stuck in a situation where a borrower has this unpayable, unaffordable private loan, there are other options. You should look for violations. They do come up. There is fraud, whether it's on the part of the lender, or most private loans will have a holder clause, meaning that if the school took part in the origination of the loan, the lender's on the hook for any fraud on the part of the school. So deceptive practices claims can be brought against private lenders. For some folks, the Fair Debt Collection Practices Act will apply. Obviously, it has to be a third-party debt collector, but it will apply. And then any other state and federal consumer protection laws that one can dig up. These will apply for private loans. Unfortunately, it is a more limited scope of what you can do for these borrowers, but the good news is it's probably within your wheelhouse already. So that's the last piece of substance that I'm going to give you. There's some resources that the National Consumer Law Center has. We do run a student loan listserv. Have about 200 members of the listserv right now. It is growing as student loans is becoming a more important, a hotter topic. But it's certainly not an overwhelming listserv to be on, usually, just a couple messages a day. We do have our website, studentloanborrowerassistance.org. It is designed to be a self-help website, so hopefully it'll be accessible for both you and your clients to go through. We have some packets on how to apply for hardship, for example, if you're experiencing administrative wage garnishment. And just a lot of general information about the different rights and options that borrowers have. We do also have a student loan law manual. If you're doing a lot of this work, I really encourage you to get that. Almost any questions that we've gotten are covered in the manual. Not all, but many are. And so there's a lot of material in that manual on the companion website that goes with it. If you do have questions and you've checked the other resources that we have available, we're available to answer questions from time to time. We also appreciate people giving us a note. If you see recurring problems with borrowers, it's helpful in our policy advocacy to help direct us in what we're trying to get the other agencies to do. Lastly, there's some other websites you should know about. The Education Ombudsman. If, for some reason the servicer doesn't do what they're supposed to do, you can contact the Ombudsman, who is supposed to kind of be the intermediary there. If it's a FFEL loan, a lot of the FFEL guarantee agencies will also have some ombudsman or other kind of customer service, customer advocate role available. And then these are just some other organizations that work in this area that have a lot of useful information on their websites too. So with that, here's my contact information. You can give me a call, send me an email, but I will stick around to answer the questions we have now.
Okay, great. Thank you. So first of all, the PowerPoint was sent around to folks already in the form of a PDF. If you have not received it or you are unable to access it for some reason, please send an email to Michelle Peterson, mpeterson, @empirejustice.org, and she can resend that to you. Okay. So there are a number of questions. The first one, Persis, I think that you have already answered, but I just want to make sure that they heard it. Do private loans stay on your credit report indefinitely until they are paid?
No. Private loans do not stay on indefinitely. They are subject to the 7-year rule. Federal loans are also subject to the 7-year rule. So there is one type of loan that can stay on indefinitely until it's paid, and that's a Perkins loan. And that's for some weird quirk in the law. They carved out Perkins loans. But every other type of loan, even if it is still a legally enforceable loan, has to be removed from the credit report 7 years after all negative information. I mean, if you are current on your repayment, it'll still be there, but negative information needs to be removed after 7 years for both federal and private loans.
Okay. If the borrower has consolidated, how will it appear on their credit report?
So that's a good question. And I realize that I did not specify beforehand that by consolidation, what I mean by consolidation is consolidation into the federal direct loan program. And so these will sometimes appear differently. It may say, and I'm thinking about this because currently all Department of Education loans are actually serviced by private entities, and it's usually the private entity who is collecting on this loan. So it'll usually give the servicer's name, and it'll sometimes say Department of Education. But this is actually kind of new, so you may have seen prior that it would just say direct loans, and all of that is kind of background to say I don't think it actually appears any differently. As I don't think that a consolidated loan will indicate that it is a consolidated loan. The only thing will be that if you have a consolidated loan, it should appear, and your other loans will appear too, but they should appear as paid. And then the consolidated loan should roughly appear to be the balance of those unpaid loans.
So for what it's worth, my laundry list of loans, I believe that the ones that are consolidated, they still show up as separate loans that are unpaid, but then
they are separate loans. Yes,
right.
It will be a neutral on the credit report. Absolutely.
Right, and then there's other ones that show paid, and then there's a new one that shows that it's being paid. So
right.
From the credit reports that I have seen from my own personal experiences, that you can't really tell which are consolidated and which are not.
Right. The credit report is only useful insofar as you know how much you owe and where you're behind, but it's not necessarily useful to figuring out what type of loan you have.
Right.
Although it does hopefully give you at least the contact information on who to contact, which could provide more information.
Okay, so let's see. I assume the formula is applied to debt plus interest, which has accrued. Any chance of getting a creditor to reduce the accrued interest?
The accrued interest is incredibly, so the actual interest rate is actually set by statute, and so they do not have any discretion to reduce the interest rate on a federal loan. On a private loan, however, you may have success. I've not actually been successful myself in negotiating this, but it is a theoretical possibility to negotiate a lower interest rate on a private loan. And actually there are some recommendations by the CFPB actually that they should start doing that, but currently there's no requirement for them to do it. In settlement if you're able to pay a very, very large lump sum on the loans, partially because the bankruptcy rights are so limited, a lot of lenders are less generous in their settlement terms. The general rule for federal loans that the Department of Education sets out is that they rarely settle for less than 90% of principal and interest total. I've seen it happen, but it's in a very, very rare circumstance to get less than 90%. In the private loans, I have seen settlements closer to 50% of the total principal and interest owed, but those are those are also rare circumstances, but they are more flexible.
Let's see. When consolidating a loan, does the interest rate on the new loan go up? Let's answer that question first. There's a second part to it.
Okay, so that's a great question. And the way that the federal consolidated loans work is it is actually a weighted balance of your loans. So what that means is the effective interest rate should not change with a consolidation. The only way that that practically matters is if borrowers were not making income-based repayments but were targeting their payments. So if a borrower was trying to be strategic when they had multiple loans and wanted to pay off the higher interest rate loans first over the lower interest rate loans, they couldn't do that after consolidation. But unless they were doing that, their interest rate should not effectively change with a consolidation.
And then the second part is with rehabilitating a loan, does the interest rate stay the same?
Yes.
Okay. So let's see. What if a borrower was working with a financial advisor who was going to get them into a repayment plan and never completed the process?
That borrower is out of luck, unfortunately. You know, hopefully the borrower will catch it before the 270-day mark appears, because even at day 269, a borrower can apply to be in income-based repayment, for example. Or the other thing that can happen is, one thing I didn't mention about forbearances is that they can actually be backdated up to a year. So if a borrower is on day 269, they have the ability to call up their loan servicer and request a backdated forbearance which can cover the entire period of the delinquency, because a forbearance can be up to a year and the delinquency is 9 months. So they could use that, but they could actually just apply for income-based repayment right then and there as well. They may be on the hook later down the road for any late fees that they've accrued during that 260 days, but they can prevent at least the default that way. Now, if the borrower has crossed over that 270-day mark, unfortunately, there really isn't. I mean, there is no way to raise that somebody else screwed up, even if it's the Department of Education. So unfortunately, in that circumstance, the borrower would be out of luck if they've crossed the 270-day mark, and they would have to follow whatever option, you know, the consolidation or rehabilitation options.
And that, I think, is the last of the questions.
Excellent. Well, thank you.
Okay, so this has been very helpful, Persis. Thank you. And to those of you, hopefully this has been helpful to you as you have stayed on to the very end. And if you have not, again, if you have not received the PowerPoint, please shoot an email over to Michelle Peterson and we can resend that to you. And with that, we are all done. Have a nice afternoon, everyone. Thank you.